Welcome to the Deep Dive, where we cut through the noise and get straight to the insights. Today, we're diving into something really interesting, actually a paradox that just played out with IBM's latest earnings. If you follow tech or business news, you probably saw the headlines for Q2 2025. And, on the surface, it looked pretty good. Overall revenue hit $17 billion, which comfortably beat the consensus estimate around $16.58 billion. And the non-GAAP EPS, earnings per share, that came in strong too, $2.80 versus estimates around $2.65. Now, normally, numbers like that, they signal really solid execution, don't they?
Oh, absolutely. I mean, by any traditional measure, those are strong beats. You'd typically expect the stock to climb. But, and this is the twist with IBM, their stock actually dropped. Quite significantly, in fact, right after the announcement. It's just the kind of thing that makes you step back and ask, okay, what really happened here?
Exactly. And that's precisely what we're going to unpack in this deep dive. We want to go beyond those immediate market reactions, which seem a bit contradictory. We want to understand the actual underlying quality of IBM's quarter. We'll look at some strengths that maybe got overlooked and also pin down this crucial show-me story that IBM is now facing.
Right. So our mission today is really to guide you through this, let's call it, nuanced financial story. We've pulled together the earnings analyses, market commentary, company statements, all of it. We'll explore why what seems like a small revenue miss in just one area managed to overshadow some really powerful performance elsewhere. The goal is to give you a full picture, a comprehensive understanding of what went down, and importantly, what it means for IBM moving forward.
Okay, so let's pull back that curtain then. Those headline numbers we mentioned, $17 billion total revenue, $2.80 non-GAAP EPS, solid beats. Revenue was up 8% year over year.
Yeah.
And the bottom line looked, well, unequivocally strong, right? That 15% jump in non-GAAP earnings per share. So just looking at that immediate picture, what does it tell us about IBM's operational health?
Well, what's fascinating is that while the market really zeroed in on, certain top-line details, the company's underlying financial health actually looked quite strong. A real standout was the profit margin expansion. It was pretty broad-based. The non-GAAP gross profit margin, for instance, expanded by 230 basis points year over year. That's 2.3 percentage points, up to 60.1%. That's a significant improvement in profitability. And that was driven, they said, by a favorable revenue mix, particularly those high-margin mainframe sales, and also the continued contribution from their high-margin software segment.
And it wasn't just gross margins, was it? Their non-GAAP pre-tax income margin also climbed, up 110 basis points to 18.8%. That really shows the efficiency gains weren't just like at the cost of goods level. It flowed through the operating expenses too, suggesting those productivity programs are working.
Exactly. And if you connect this to the sort of bigger picture, maybe the most powerful signal of management's confidence was their cash flow. IBM generated $2.8 billion in free cash flow just in Q2, which brought the total for the first half of 2025 to a really robust $4.8 billion. Management made a point of highlighting this, said it was their highest first-half free cash flow margin in many years.
Right, and that strong cash generation, it wasn't just a one-off for the quarter. It actually gave them the confidence to raise their full-year guidance for 2025 free cash flow. It went from saying approximately $13.5 billion to above $13.5 billion. In today's environment where resilience is so valued, that kind of upward revision...
Well, it's a powerful statement about their execution confidence. It really is. So, okay, you've got robust profitability, exceptionally strong cash flow, yet the stock dropped. This brings us right back to the core question. What drove the market's negative reaction? And the heart of IBM's Q2 story, it seems, lies in how its main business segments performed differently. It was almost a tale of two businesses. You had a surging infrastructure segment, which basically made up for a slight but strategically important stumble in the software segment.
Ah, software. Yeah, anyone following IBM knows that's seen as the crown jewel, right?
Yeah.
The key to their future value, that high-margin growth story. So what happened there?
Okay, so software delivered $7.4 billion in revenue. Now, that was actually up a solid 10% year over year. And this is the key point, it fell just shy of what analysts were expecting. Consensus estimates were sort of clustered around $7.41 billion to $7.48 billion. And this minor miss, even though it sounds small, seems to be the main reason for that negative stock reaction. It spooked investors who are really counting on flawless execution from this high-margin part of the business.
Okay, so even with that slight miss overall, what were the trends inside the software segment? Was the weakness spread out, or was it more specific?
Actually, beneath that headline number, the performance in software was quite mixed. It wasn't all bad news at all. On the strong side, the hybrid cloud business Red Hat in particular saw its growth speed up. It rose a really robust 14% at constant currency. And constant currency just means we're stripping out the effects of currency fluctuations so you get a clearer view of the underlying business.
Hmm.
Management talked about extreme demand for Red Hat Enterprise Linux, especially as a platform for AI workloads. And OpenShift grew over 20%.
Okay.
The automation portfolio also did well, up 14%, helped by the HashiCorp acquisition. Even data and AI grew a healthy 7%.
Right, so if all that was strong, where was the drag? What pulled the overall segment number down just enough to miss?
That was concentrated in one area, the transaction processing business. It actually declined 2% at constant currency. Now, this subsegment is very closely tied to IBM's mainframe ecosystem. And what's really fascinating here is the direct link management is drawing between the software weakness and the incredibly strong performance of the infrastructure segment.
You mean the mainframe, of course.
Yeah.
Because that part of the business absolutely roared back, didn't it? Infrastructure segment revenue, $4.1 billion, surged 11% at constant currency. That blew past estimates and was the single biggest reason the company beat overall revenue expectations.
Precisely. And the engine driving that growth was the IBM Z mainframe business. It saw a massive 67% constant currency jump in revenue. This marks the start of a powerful new product cycle with their Z17 mainframe. And management was really keen to link this hardware strength to their AI strategy. They emphasized the Z17's success is fueled by its embedded AI capabilities. Like the new Telin 2 processor lets clients run over 450 billion AI inference operations a day right on their critical transaction data.
Okay, so let's connect those dots then. Mainframe sales surged, but transaction processing software revenue declined slightly. What's management's argument here? Are they actually saying that the booming mainframe sales caused the software miss? That sounds a bit counterintuitive.
That is exactly the argument they put forward, and it's absolutely critical to understanding their narrative for the quarter. The CFO, James Kavanaugh, explained it this way. Clients prioritize their capital spending budgets to get their hands on these new AI-packed Z17 mainframes, and in doing so, they temporarily diverted spending away from the associated software that runs on, the older mainframe transactions. So their claim is, it's not a sign that underlying software demand is weakening, it's more of a temporal shift, his words, in spending within the IBM ecosystem. Basically, the money was still spent with IBM, just on hardware first, because, a mainframe is a major, lumpy investment.
A temporal shift. That's certainly a bold claim. It definitely sets up a critical show-me situation for the second half of 2025, doesn't it? The real test now is for IBM to prove that this deferred software spending actually shows up as the Z17 hardware cycle matures. Management is projecting that the transaction processing business will recover enough to hit low single-digit growth for the year. That's a pretty strong expectation for a rebound.
It is. And, while this mainframe cycle is impressive and it's clearly a big financial tailwind for 2025, it's important to remember these things are inherently cyclical. This huge boost now is great, but it's going to set up some really tough comparisons for IBM come 2026, once the cycle peaks. Strategically, the real value is how effectively IBM uses the significant cash flow generated from this hardware boom to reinvest. Reinvest in those more strategic recurring revenue areas like software and their AI-led consulting businesses.
Speaking of consulting, that segment's faced some headwinds for a while now. But it did show some signs of stabilization in Q2, didn't it? Revenue was $5.3 billion, flat at constant currency, which actually broke a streak of 5 straight quarters of decline. That's progress, right?
It definitely is progress. And the leading indicators look a bit better, too. The segment's backlog, that's a measure of future contracted work, it grew a healthy 4% compared to last year. They also added over 200 new clients. However, management's tone was still pretty cautious. They mentioned a challenging pricing environment and ongoing hesitation from clients on discretionary spending, especially within the U.S. federal government. It kind of suggests that while clients are maybe re-engaging with tech projects, they're still wary about committing to those big discretionary digital transformations. It sounds more like they're approving smaller, more targeted projects with a clearer ROI, often centered around generative AI.
Which brings us nicely to IBM's central narrative, their whole transformation into an AI leader. A big number they pushed hard was their generative AI book of business. They said it surpassed $7.5 billion since inception, with a huge $1.5 billion added just in Q2 alone. I mean, that's an enormous eye-catching number. But for investors, the question always comes back to this, doesn't it? How much of that book actually turns into near-term, high-quality, recognized revenue? Especially in that high-margin software segment the market watches so closely.
Exactly. And it's crucial to understand what that book of business number actually is. It isn't recognized quarterly revenue. It's more of a forward-looking metric. It aggregates various AI-related commercial activities, things like consulting signings, direct software sales, the value of recurring revenue from AI-infused products. It's a mix. The demand drivers seem strong: AI agents on Watsonks, their Granite Foundation models, the consulting services to deploy it all. CEO Krishna mentioned big names like UPS, Verizon, Nestle using their tools. However, the market's skeptical reaction to these earnings, where that small miss on tangible software revenue seemed to outweigh this huge forward-looking AI number, it suggests there's a bit of a credibility gap. Investors seem to be prioritizing certainty and recognize high-margin software revenue now over this less defined forward-looking metric. The market essentially wants to see this book convert into predictable, high-quality, recognized revenue streams.
Right. So this quarter has really intensified the market's demand for concrete results in software. What's IBM's playbook then? How do they plan to ensure this conversion happens and deliver strong performance in the coming quarters?
Well, underpinning their confidence is a really disciplined operational strategy. It's focused on productivity, profitability, and smart capital allocation. A key part of that is their aggressive productivity and efficiency program. They actually raised their target for annual run rate savings. They were aiming for $3.5 billion. Now they're targeting an ambitious $4.5 billion by the end of 2025. They're even embedding AI across, I think they said, more than 70 internal workflows, using their own software to try and drive a competitive edge internally.
And the CFO, Kavanaugh, confirmed that these savings flow directly to the bottom line, right?
Supporting that margin expansion we talked about and helping fund continued investment in strategic areas like AI R&D. I think AI R&D was up 14% year over year. So this productivity engine is clearly critical to their profitability and their ability to raise that free cash flow guidance. Absolutely. So if we look at the big picture, IBM's forward-looking guidance for the rest of 2025, it paints a picture of real confidence in their profitability and cash generation. They reiterated their full-year revenue growth forecast, at least 5% at constant currency. That stayed the same. But crucially, as we said, they raised the full-year free cash flow guidance to more than $13.5 billion.
Yeah, and that decision raising free cash flow guidance while keeping the revenue forecast steady, that feels like a deliberate strategic signal. It basically communicates that, okay, maybe there's some uncertainty around the top line growth, but management is extremely confident in their ability to control costs, drive productivity, and efficiently turn profits into actual cash. Sort of de-risks the investment case, doesn't it? Suggesting that even if revenue growth is just okay, that robust cash flow is pretty much assured. So, wrapping this up, what does this all mean for you listening? IBM's Q2 results really presented a complex story. On one hand, the company delivered what looks like a fundamentally strong quarter. You had robust profitability, that non-GAAP gross profit margin expanding nicely to over 60%, and impressive cash flow generation, underscored by that significant upward bump to the full-year free cash flow guidance, now above $13.5 billion. That's a powerful signal of management's confidence in their operational execution.
But on the other hand, the market, which is laser-focused on long-term strategic growth right now, it really fixated on that slight revenue miss in the critical software segment. It was interpreted as maybe a potential crack in IBM's engine of high-margin growth. That happened even though management offered that explanation, the temporal shift in client spending towards the new Z17 mainframe hardware.
So this quarter has effectively put IBM in a position where they really need to prove their thesis in the second half of 2025. The pressure is squarely on management now to show their argument is correct. They need to demonstrate that the software segment, particularly that transaction processing business, does rebound as the Z17 hardware cycle matures. Remember, they're projecting low single-digit growth for the year there, which is a notable expectation.
Right. And additionally, they need to show a clearer, more quantifiable link between that growing generative AI book of business, now over $7.5 billion, with $1.5 billion added just last quarter, and actual recognized high-quality revenue streams, especially in that all-important software segment. This isn't just a show-me story for IBM. It's kind of a fascinating snapshot of how the market is recalibrating expectations for big, established tech companies right now. It reveals this deep-seated investor skepticism, maybe a prioritization of tangible, immediate growth in those key strategic segments, even when strong cash flow suggests underlying health. It's a signal that promises of future AI potential, no matter how big that book of business sounds, are maybe falling a bit short without concrete recognized revenue to back them up right now.
So here's something to think about. In an environment like this, where companies constantly navigate complex tech shifts and economic uncertainty, how much does a clear focus on operational efficiency and reliable cash flow generation like IBM's push for $4.5 billion in annual savings, how much does that ultimately de-risk an investment case, even if key growth segments face temporary bumps? What does this deep dive into IBM's performance tell you about what the most crucial indicators of a company's true health might be, beyond just the immediate stock market reaction?